you all that are already here. On behalf of Silka Hubbard, who is from the Kentucky-Tennessee Conference, and Ray Hartwell, who is from the Georgia-Cumberland Conference, and the Florida Conference, Plan Giving and Trust Service Departments, we all want to welcome you to this presentation. Before we get started, I would ask Pastor Reyes to lead us in a word of prayer, please. Luis, can you pray for us?
Yes, I'll be glad to do that. Heavenly Father, we thank you for this moment. We thank you for the time you're giving us to learn and to be able to serve you even better. Thank you for taking care of each one of us this evening. May you bless us. May you bless those who are starting to get into the Zoom meeting, and through us, may you bless many, many more. In Jesus' name we pray. Amen.
Amen. Amen. Thank you, Luis. The Financially Savvy Seminars for Seventh-day Adventists. This is our second year offering these. We've got several more lined up for the rest of the year, and we will tell you about those a little bit. But before we get started, let me give you some preliminary information. Adele, can you share the slides that we have on Plan Giving and Trust Services? Good. Okay. Can everybody see that okay? Looking good? Okay. So our department consists of myself, Andrew Elliott, Luis Reyes, Adele Galvis, and Maria Pino. We all, including Ray and his team and Silka Hubbard and her team, are all certified by the NAD. We talk about being certified. We're not certified as, and we'll talk about this also, as financial advisors or as CPAs or as attorneys, but we are certified through the NAD. We go through periodic, usually every 2 to 3 years, audits to make sure that we're keeping our documents correctly, that the documents that we have are correct, and that any financial fiduciary responsibilities that we assume, we are carrying those out faithfully. We are required to have continuing education, 16 or more hours every year. So we try to stay sharp in the information that we're sharing with folks. Membership has its privileges, and some of those privileges include free consultation with one of us, one of your certified estate planners, free preparation of basic estate documents, including a last will and testament, durable power of attorney, healthcare power of attorney, and a living will. We will notarize these documents for you and witness them free of charge. If you do them, anywhere else, they charge anywhere from $5 to $10 per page. And then free consultation with an actual attorney. That is part of the program that we offer. So all of these documents are available to you. One thing that I would like to spend a minute on is our charitable gift annuity program. Our charitable gift annuities, currently the rates just went up as of January 1, and currently rates are as high, payout rates are as high as 9.7%, if you can imagine that. That is absolutely amazing. Of course, the rates are based on your age. If you're familiar with the charitable gift annuity, basically, it is a gift that a donor makes to the church or to one of their other beloved ministries. In exchange for that gift, that ministry or the church will pay the donor back an annuity or an annual payment. Usually it's broken up into monthly or quarterly payments, whatever the annuitant would like. And then and those payments come to the annuitant for the rest of their life. And I have seen many, many cases where the annuitant lives long enough that they actually get back more money than what they actually put in. So it is a phenomenal program, especially for Adventists who generally live longer than the regular population. Once the annuitant passes away, then whatever is remaining in the annuity fund then goes to the nonprofit, to the church, the ministry of your desire, whatever the case may be. So again, these payouts are for the rest of your life. And regardless of how long you live, you'll get that payment every month or quarter. There are generally tax benefits for the gift that you've made. The minimum to do what we call CGA, charitable gift annuity, is $10,000. You can arrange for your payouts to be deferred till later in life. There are several benefits to that. And then, of course, the best thing of all is that the proceeds do support the Florida local church or ministry of your choice. So that's how a charitable gift annuity works. We would love to talk with you about those more. If you are concerned about the volatility in the stock market, or if you are tired of having your bank offer you a 1 or 2% return on your money, I highly encourage you to reach out to your local conference, whether that's Georgia Cumberland or Kentucky Tennessee or Florida, and let us give you more information about the charitable gift annuity. Doesn't cost you a thing to learn more about them. Thank you, Adele. Disclaimer again, I said we'd mention this later. None of us here are attorneys or CPAs. I don't know about our presenter, Ray Descalso, if he has any of those titles, but I do know he is a licensed financial advisor. And I mentioned earlier at the beginning of the call, I had an opportunity to sneak a peek at his deck of slides, and I'm so excited about the information that he's going to be presenting tonight. So a couple of housekeeping things. Please do keep your microphone muted. You never know when the dog is going to bark or somebody's going to ring the doorbell. And we hate that distraction would happen to you, but we hate it even more if it distracts all the rest of us. So please do keep your microphone on mute. And if you have any questions, at the bottom of your screen, if you roll your cursor over the bottom of the screen, you should have an icon that says chat. I'm going to click on mine right now and just say hello, everyone. And once I click enter, you should see that message in the chat box there. It either pops up on your screen or you'll see the number 1 in your chat box saying there's a chat waiting for you. So if you have any questions, please enter those in the chat. Thank you. There's a couple of things right now. We'll address those throughout the seminar or towards the end as we go. All right, without further ado, I do want to introduce my good friend, Ray Descalso. He is one of us, folks. He's Adventist. He went to Forest Lake Church, got his degree in theology, I believe, at Andrews University. He understands our priorities, and he has been a financial advisor now, I forget, 15 years or more.
2005, yeah.
Yeah, it's been a while. So Ray, we are so honored to have you with us. I just real quick, I just want to say, Ray did a presentation for us last year. I still have the notes from that. Really good stuff. And some investment strategies and tips. And so Ray, I'm just anxious to hear what you have for us tonight. Thank you so much for being here.
I'm sorry
Thank you.
if I may interrupt for a second. Since you said that, it's good to have a little notepad and something to write down, because the suggestions are going to be very good.
Excellent. Excellent. Thank you so much. Let's see how good I am at technology. Let me share my screen. First of all here. Yeah, as mentioned before, my name is Ray Descalso. I am so delighted to be here with you today. It's an honor and a privilege. Can you see a screen that says, and it should be a full screen. Uh-oh, there we go. How about that? Should say money blunders and how to fix them. And it should,
Yes,
you don't see
perfect.
my notes. Or, okay, good, good, good. Hey,
Looks good, Ray.
cooking with gas. Before we go any further, so what I want to do is I want to cover 3 mistakes that I see, and we may have time for 4 mistakes, because ultimately, retirement planning is kind of like the Hippocratic Oath. Do no harm, right? If you can stay out of the ditches, if you can stay out of the bad places, you're going to be okay. And so we have to make sure that we don't mess things up. And we want to share with you some actual things that we can possibly do. Thank you, Phil, for that generous introduction. All of it was true. I went to undergrad at Southern and then got my MDiv at Andrews. One correction, although I do attend Forest Lake Church now, I was a pastor at Markham Woods Church there in Longwood. So that's the only thing there. But we'll go ahead and get started here. And if you have any questions, what I want you to do is, like was said before, write them down on a piece of paper. I may answer the question. If I don't, feel free to ask me. I think the next 3 or 4 hours that we're spending here together are going to be really fantastic, and you're really going to enjoy yours. Just kidding, just kidding. But there will be an altar call. So no, there's no altar call either. But I will say this. If you have a question, let me back up. So I think I said it here. I am a Dave Ramsey Smart Investor Pro. And Dave Ramsey is a great guy. He's got a radio show. He's faith-based, and he talks a lot about some very Solomonic principles for financial wealth and financial planning. One of the things, as a Smart Investor Pro, he'll get people who call his radio show and said, I want a financial advisor, and he'll suggest my name as well as 4 or 5 other people. And one of the things that all of us will do as Smart Investor Pros is we will sit and talk with you for 15 or 20 minutes and figure out what you need, answer your questions. Of the 5 people who will come to me over the next 2 weeks, really 3 or 4 of them don't need a financial advisor right now. They need some direction where to go. They need to reassess where they're at, and they're going to be just fine. If you have a question, I'm more than happy to help you. There's no obligation. There's no worries about that. So feel free to give me a contact. If you have a personal question that you want to ask me and say, hey, what's going on? So, and in fact, I have Phil, stay tuned. Don't go anywhere, because I have a question for you that will actually fit in later into the conversation. I asked it in the chat, but I think I'll just redo it here. So let's talk about some money blunders. The first money blunder I want to talk to you about is taking withdrawals, taking income from a portfolio that's going down. Now, I know what you're thinking. You're thinking, well, Ray, that's not really very, oh, by the way, we call a portfolio that's losing money, or a stock market that's going down, we call it a bear market. Hence the picture of Frank the bear there. So we don't want you to take money out of a portfolio that's losing money. But I know what you're thinking. You're thinking, well, Ray, that's the nature of the stock market and the bond market. And by the way, 1931, 1969, and 2022 were the only 3 years in history that we're aware of where both stocks and bonds lost money in the same calendar year. Usually, you go to stocks and it's volatile, right? And when stocks go up, bonds stay flat or go down. And usually when stocks go down, bonds go up. Guess what happened this year? Everything went down. So what I'm telling you is, if you're a retiree, or if you were planning on retiring and taking money out of your portfolio, you're not allowed to take any money out. So how are you supposed to live if your financial planner is saying, don't take your money out? Well, here's the key. The key is you don't pack your bag to go mountain climbing when you get to the top of the mountain. What you have to do is you have to plan ahead, because you know that you're going to have some good years and some bad years.
I think he's talking back.
That's it. So the 4 of us will start the kids.
I think we got some people who have their not muted. Okay, let's say we're good. So
I am muting everybody.
oh, perfect. So let me give you an example here of Mr. A and Mr. B. They both came to me some 25 years ago. I know I look pretty young, Adventist lifestyle, but 25 years ago, they came to me and they both of them gave me $100,000. And I invested their money in 2 different portfolios. Now, this is hypothetical. This is not a real, this is a story. It didn't actually happen, but stick with me here for a moment. We put their money into different portfolios. Mr. A, he went up 29, 18, 25. First 3 years, he said, wow, Ray, you are absolutely fantastic. You know, and he just thought I was a genius. Mr. B, who started on the same day with the same amount of money, we invested his portfolio and he lost 3 years in a row, minus 12, minus 21, minus 14. But somehow I was able to convince him, stay with it. It's a long-term situation. And you know what? It worked out for him because the last 3 years, he made 25, 18, and 29% returns. Conversely, Mr. A lost 14, 21, and 12. They both ended up after 25 years in the exact same spot with a little over $600,000. Now, what's interesting is, and it kind of gives it away there in the middle, it says it's the same average annual return, but the return rates are inverted. In other words, both of these portfolios got exactly the same rate of return. We just flipped and reversed the order of return. So you see Mr. A had 29, 18, 25. Look at the last 3 years of Mr. B, 29, 18, 25. Now, why am I showing this to you? Because it's an exercise, if you will, an exercise of helping you to understand that if you're putting money away in preparation for retirement, yeah, you have time. And the reality is yeah, your portfolio will most likely come back. What it doesn't really matter when you're saving for retirement, what your sequence of returns is, as long as you get more good years than bad years. Well, what happens though, if we took the same clients after 25 years of working and they say, okay, Ray, what we would like to do is we'd like to take 5% out of our portfolio. And Mr. A and Mr. B said, listen, can we get the same returns, exact same returns that we got the first 25 years? Because I sure did love getting getting 8% average annual return. I mean, who wouldn't want an 8% average annual return? But here's the issue. The issue is not the average annual return. The issue is when those returns come to you. Let me show you what I'm talking about. You see, in the next slide, what you'll find out is that Mr. A and Mr. B needed to take 5% out of their portfolio. And why is it? There we go. They want to take 5% of their portfolio, 5% annual withdrawals. The average annual rate of return is still 8%. Mr. A, he does absolutely fine. Starts out with 685 and he dies with, how much did we get to, let's call it 1.5 million bucks. However, Mr. B goes to retire, getting the same sequence of returns, which is going to equal 8% annually. And what happens? Minus 12, minus 21, minus 14. Now, why did this happen? Because if your first years in retirement, in other words, when you start taking income, if your first years are your worst years, it will very seriously impact your retirement. So why is that? Let's think about it. When you were putting money away, what did you do? You put money in 2008, the market's crashing, you still put your money in and you still got your match. And you put in $1,000 a year and your portfolio went down $2,000 and you're like, oh, what am I doing? Didn't matter. You were buying shares. You were buying them on sale. I mean, if you went to the car lot and what used to a car that used to cost $100,000 now costs $80,000, you say that's a deal. If a car that costs $50,000 now costs 25, you'd buy two. But what we have to realize is we don't do that with the stock market. We kind of have the reverse mentality. And when you're putting money for a retirement, bear markets are wonderful. Last year was a great year to be putting money in the stock market if you're under 55 years old. However, if you are in the fragile decade, the fragile decade is 5 years before and 5 years after you personally take income. So the fragile decade can move around. It could be when you hit 70, you're going to retire. It could be you're 62 when you retire, whatever the age is for you. If you're going to rely on your portfolio, you've got to prepare for the bad markets because pretty soon you're going to start taking money out. So what does everybody do? Everybody takes all their money and they put it in one of these target date portfolios. Now, if you don't know what that is, a target date portfolio is essentially they would say, okay, you're going to retire in, let's say 2020. So it's now 2015, but you own the 2020 portfolio. And the 2020 portfolio 20 years ago was mostly 80% equities. And now it's 60% bonds. Why? Because we're scared. Well, what happened in 2022 is that a 2025 portfolio, even though it was mostly in bonds were down 12 to 15%. First time it's happened, well, third time it's happened in recorded history. And the reality of it is you've got to come up with a way so that when you go to take money out of your portfolio, risk is off the table. So how do we do that? So it's a big blunder, right? Let me first of all say this. It is a huge blunder for retirees to think to themselves that we can be okay in putting our money into the stock and the bond market, and that's going to keep us safe. I know what you're thinking. You're thinking, well, Ray, statistically, I'll get an 8% return if I have a 60-40 portfolio. That's wonderful. But what the inventor of the term fragile decade, his name is Wade Pfau. Wade Pfau did a study, and he took basically the same metrics and had you retire from 1950 to 2005 when he completed the study. And what he found is it did not, if you invested in the exact same thing, what mattered in your retirement was essentially the day you were born and the day you retired. There's way too much luck involved. And so statistically speaking, law of large numbers, you're fine. But the problem is you're not a statistic. You're an actual personal human being. So how do we solve this problem? So where you can sleep at night and make sure that, you take yourself out of the statistic pool. Well, that's how, there we go. But here's why I want to remind you of this. People know this now. This is a little bit of an old chart, but everybody thinks the stock market goes up, buy and hold, you'll be fine. But the reality of it is, as I mentioned, 1906 to 1924, 1929 to 54, 1966 to 1982. These are 1725, 11-year bear markets. We all remember 2000, 2010. You put in $100 into the stock market and you just bounced around and made -1 to +1% return. We've come to the end of a bull market, in my humble opinion, and we're now in the middle of a bear market, although no one seems to agree. We can never really know where we are until we see it in the rearview mirror a couple years hence. I'm of the opinion that we are in the middle of a bear market and we're not out of there yet. But nonetheless, the point is they exist. And if that's the case, we have to realize what Mr. Vanguard, the veteran of the index of the 60-40 portfolio, he says, look, you're going to have declines. This was back in 2013. He says, we're going to have a 50% decline in the coming decade. Well, 2013 and 2023, perhaps he was a bit of an oracle. So how do we solve this problem? The way we're going to solve the problem of this concern of taking income inside the fragile decade, not taking money from a place where we're losing money, is something that I call stability planning. So essentially, and this is not invented by me, I have plagiarized the very best ideas that I could possibly find. And so this is also something where I'm always stealing from brighter people than myself. Some of these ideas come from the College of Financial Planning. Some of you may have heard of a theory or a financial planning strategy called bucket planning. What this really is time segmented allocations. Now, you know, when we talk about allocations, we usually mean large cap, Microsoft, mid cap, I can't think of a mid cap company now, small cap, international, that type of thing. What this is about is segmenting or allocating your portfolio across time. Easy to understand. Let's talk about the liquid pillar. And there's 3 pillars because you need at least 3 pillars to make a stool work. So here we are with the liquid pillar. The liquid pillar is going to be 3 to 12 months of income. Now, of course, when I'm talking about 3 to 12 months of income, I'm talking on the day that you retire. Dave Ramsey's big thing is while you're in your working years, 3 to 6 months in your emergency account. Once you get to retirement, having 6 to 12 months in the bank makes a lot of sense. And think about it. One of the reasons why it makes a lot of sense is if your portfolio is down, right, and you're losing money in the stock market, well, that's not the best month. That particular month is not the best month to take money from your IRA and put it into the bank. What if you were just to spend the cash that you have? And what I find a lot, one of the blunders, a sort of a subset blunder, is so many people will sit on, have $1 million portfolio or even a $500,000 portfolio, and they'll have $200,000 in the bank. They sold a property or something. So if you look at the weighting of it all, they've got 2.5 years in the bank, and they're draining the growth possibilities of their IRA and paying taxes. So they're taking too much money out of their IRA. We need to spend some of that cash. Why else do we need to have 6 to 12 months? I should really change it to 6 to 12 months. So we're talking about retirees now. Well, one of the big reasons is we need to have pre-planned expenses. It's very difficult to know for sure that the mutual fund that's up 10% today is going to be able to pay for that cruise to Alaska or that trip to the Holy Land in 6 months to a year from now. In 2022, January, the market was at all-time highs, And by August, when you're about to set sail on your cruise, you're down 20%. That delta, that amount that you've lost, maybe the vacation doesn't work. We need to take those funds, we need to put them somewhere, earmark them, emergencies. I'm going to change that word emergencies to opportunities. Let's not be negative about it. You get the emergency of a leaky roof, the emergency of a broken air conditioning in the southeast of the United States in summer. Let's not call it an emergency, let's call it an opportunity. Because it's an emergency if you don't have the money. It's an opportunity to upgrade your roof and to upgrade your air conditioning if you planned ahead. That's why you have this money. The money needs to be FDIC insured. It needs to be in a bank, in other words. Although, there's some other possible funds that aren't necessarily FDIC insured. You could put things like it's escaping me now. The conference has it. It's paying, was paying like 3%. The rotating fund, what's it called? Phil, help me out here.
Southern Union Revolving Fund.
Revolving, not rotating, revolving fund. Yeah. Now, of course, there's every time you get away from FDIC insurance, you're getting a little bit more risk. So we can talk about that later. But the point is, this has to be liquid. You have to be able to get to the money. The number one thing I bolded it, you want to be able to sleep at night. So if you can sleep at night with 6 months, great. But if you can't, let's get you up to 12. And you need to be planning towards your retirement with the idea that I want to have my number. And so I hope to meet people 3 or 4 years before they retire, because they're within that 5 year, the cone of uncertainty, so to speak, the fragile decade. But also too, we've got these little tasks. And if you could put $100 away, $1,000 away every month, that could be very helpful to get you to a place. Now, if cash is king, why don't we put all our money in the bank? Well, I think it's obvious there's inflation risk. So right now, you're probably paying your $100, or let's just say your $50 is paying for about buys about 2/3 the gas it did a year ago or 2 years ago. We all remember when it spiked from $2 to $4 a gallon, some parts of the country more. So inflation's very real and it's rearing its ugly head. And yeah, that's a whole nother story. But I want you to remember that we can't put all our money in liquid, and you can't have all cash in your other accounts as well. So we want to have your money grow to keep up with inflation. So what do? We have some of your money in your growth pillar. Now, typically, your growth pillar is going to be your 403B, your 401A, your 401K at work, or it's going to be the IRAs and Roth IRAs that you've grown over time. And when you invest that money in the growth pillar, you want to take a portion of the growth of your money in those IRAs and whatever qualified retirement assets you have. And you want to invest it for growth, because you know that, if I want to go to the Evans Book Center, these books are going to go up in cost. Sorry, it's a ministry, but they cutting trees down and turning it into paper costs money, and labor costs money, and everything seems to go up. So if that's the case, we're going to invest for long-term growth. Well, now, here's the key. The key is if you're going to invest in this particular pillar, it needs to be money that you don't need income from for another 5 years. There we go. I've just solved the problem. What I said was a big blunder is that people put all their money in the bank, in their 401k, and they go from their 401k to the bank. Well, the problem is the money that's in your growth portfolio needs to be money that you can let it go down 10%, 12%, 15%, and you're not concerned. Why are you not concerned? Because this money isn't needed tomorrow. It will be needed in the future, but not tomorrow. Maybe not even within a year. And it gives it a chance for this portfolio, if it's down 15%, like many of us were in 2022, it gives us a chance to let it come back. And when you take money out of an account that's down, those dollars turn into gasoline. They turn into a mortgage payment. They turn into a trip, a vacation. They're gone. They're no longer working for you. You're consuming those dollars. They don't have a chance to come back like they did when you were younger. Was that a question? I don't think so. Okay, good. So now if you have a long-term focus, that's wonderful, but there's also something else that we want you to have. And that is, we want you to have a rules-based mentality. I believe I have a slide on this. Let's take a look here. Yeah, rules-based investing. And I've covered this before. The key to rules-based investing is you need to make sure that you are unemotional, that you are mechanical, and that you are repeatable. What we want to do is we want to take lots of different strategies. There's one strategy called modern portfolio theory. It's about allocation. There's fundamental analysis, which is what Mr. Warren Buffett does. Mr. Warren Buffett says, hey, this company is so fantastic. All I need to do is buy it at a fair price, and it'll over time work out well. And then finally, there's technical analysis. And technical analysis, let me stop right there. The key is to combine these strategies, but technical analysis is missing from, this is another sub blunder, if you will. So there really is all kinds of blunders here. If you don't do this, you're really missing out. Technical analysis essentially is where we take the mathematics of probabilities based upon a couple different factors. It's complicated, but here's how I explain it. When you are driving in your car, and I've told the story before, and I keep repeating it over and over again until I get famous. And here's the story. If you're here in Florida, at least, and you decide you're going to go to the beach, right? So you get on the 528, you're going to go to Cocoa Beach. It's nothing but cow pastures on either side. It's a gorgeous day. You don't see any police officers around. The speed limit is 65. If you're Phil Bond, you're going 80 miles an hour. Now, I'm not calling Phil Bond a criminal. I'm just saying it's common sense. Everybody else is going 80 miles an hour. It's safe to do so. Why don't you do it as well? So maybe you don't go 80, maybe you go 70, still a criminal. I'm a legalist. So you're going 70 miles an hour. You're going faster than the speed of the speed limit. Now, coming back from the beach here in Florida, in the summers, we get these thunderstorms, and you can only see 33 feet in front of your car. The speed limit is 65 miles an hour, but how fast do you drive? Well, the reality of it is you slow down and you don't go the speed limit. What technical analysis does is it allows us to decide whether we want to be risk on, press on the gas, or risk off, take our foot off the gas. And so putting technical analysis as an overlay on modern portfolio and fundamental analysis, what it does is it allows people in 2008, instead of writing the entire thing down and crying about it, actually start using these statistical ways of looking at the market, looking at, I don't want to use these terms, but essentially the weather, and saying, you know, there are clouds gathering. Those clouds are gathering and visibility is low. There's too much risk. We're going to take our foot off the gas and we're going to park. In fact, in 2008, really great technical analysis told people to just get off the road completely. In this case, in your IRA or your 401k, we would be instructed to use the stable value fund if you're in a 401k, or cash if you're in your IRA. And that can save you. It's better to be down 11% than it is to be down 33. If you're down 11%, all you need is 13 to get back to where you started next year. If you're down 33, you need 50%. Think about it. You've got 67%. You got to have half again as much to get back to where you started on a percentage basis. So not losing money through rules-based investing and combining these strategies will help you over time. Does it work every time? No. If it worked every time, I wouldn't be working for a living. I would have taken my $1 and doubled it so many times. I would be, independently wealthy. So it is a system to protect yourself from large losses in that particular pillar. And that pillar is, we'll go back over here, that pillar is the growth pillar. Finally, the growth pillar is about legacy focus. If you're a couple, what you want to do is you want to take a look and say, okay, well, I'm older than my wife, so I have to make sure that all of our money outlasts me and takes care of her. Typically, women live longer than men, and so that's one of the issues that we see. Again, you got to focus on your legacy. Legacy may also be gifting. Legacy may be also your kids. Now, why don't we put all your money there? Because even with the best investments, we have volatility risk. And that was the other issue. I said, you can't take money from this portfolio, especially if it's down. You shouldn't take it anyway. You should let it grow. If you need it in a pinch or you had a wildly successful year, you can take some of that money. But what I'd rather you do is let it ride. So there's volatility risk there. So we come now to the stability pillar. Now, let me ask you a question here. In the, let me make a point. First of all, the stability pillar is about taking income now. So if you are 3 years from retirement, you're going to take the money from your stability pillar first. You're going to put your money in there. This needs to be conservative. It needs to be lower volatility. It needs to keep up with inflation, right? But it also needs to be a place where we know we can get income that is not affected by the stock market or the bond market being down. Now, let me give you an example of something that could be a portion of what goes in the stability pillar. One of the things that has disappeared from this world are pension funds, right? When I started in Florida Conference in 1999, 2000, they did away with the what? 2000, maybe it was 2001. They did away with the pension and they introduced the 403B. So pensions are now really a relic of the past. If you've got one, it's because you're part of an amazing company. What out there, if you were to put in 10,000 bucks, could pay you 9% for the rest of your life guaranteed? Anybody know anything that could pay you, I don't know, 9.7%? I got an idea. Q-Phil bond, a charitable gift annuity. Now, will the charitable gift annuity, Phil, if you hear about, or anybody who can speak to this, let me know. If the stock market's down 20%, does a conference call you up and say, hey, sorry, you know, you gave us 100,000 bucks, your $9,000 annual check. Yeah, we're not gonna be able to do that. Can they do that? No, they can't. They're bound by a contract, right? Contractual investing. Is that Phil?
I said, yes, you're right.
Absolutely. Yeah, you just, if you ever have a problem, just call Phil up because he's in charge of coughing up the extra money that's missing. The point is this creates what in your portfolio? It creates stability. Okay. And so now this may not be the only thing you want to put your money in, right? Because you may need more than $9,000 in this particular case. You may need to have different types of investments, but typically speaking, what goes best in the stability pillar are contractual investments. Now, what's a contractual investment? Well, a great example would be like a 9% CD. Do they exist? No. But let's just say a 9% CD. If the stock market goes down, the bond market goes down, you have a 1% 9-year CD, 9% 1-year CD. The bank is going to give you that money, and the stock market does not matter. Why? CDs, certificates of deposit, are a contract between you and the bank. Charitable gift annuity is a contract between you and the conference. Another one is an annuity with an insurance company. It is a contract between you and the insurance company. So banks, the insurance company, a government bond is a contract between you and the government of the United States of America. So right now, let's say treasuries are paying you 4%. That's wonderful. 4% is a pretty good deal for a 1-year risk-free trade. Now, here's the issue though. The issue is that there's sometimes things can be too conservative. We're not paying high enough of an income. I get it. But what we want here is we don't want you to be in a bond. This is key, a bond mutual fund. Bond mutual funds or ETFs or any kind of bond that's not really a bond, but a conglomeration of everybody else's money to buy bonds can go up and down with value, as can bonds. But if you buy a bond with a maturity date, if you buy a contractual investment like a fixed annuity with an insurance company or a CD with a bank, we have a start time, an end time, and an interest rate, and it's all been predetermined. And so that's what goes in the stability pillar. And that is going to be where your income goes from the middle pillars to your bank account. So think about it this way. You have a 15% return in the growth pillar. You've got a 4 to 6% return in the stability pillar, but the money from the stability pillar is what's going into the liquid pillar. The liquid pillar is the bank, essentially. And then obviously from time to time, we take some of our winnings, some of our gains from the growth pillar, and we put it into the stability pillar. It's very simple. The key is finding out exactly which is the best types of investments and blending of those investments, especially in the light blue and the purple, the stability and the growth pillar. And this is a blunder that too many people do. Because what they say is, I had a 60-40 mutual fund portfolio at Vanguard or at my 403B, and that's what I'm going to retire with. It may work, but there's a really good chance, like in 2022, that it could be very detrimental to your retirement, especially in the fragile decade. But then again, too, who wants to have the stress of consecutive years being down and taking money out? So this is the stability plan, the bucket plan, the time segmented investing is one way to avoid the blunder, the big blunder, the potentially retirement ruining blunder of taking income from a losing portfolio. And that's kind of how it works. This is how trend following works. Sorry about that. I'll skip over this. So the next money blunder that I want to talk to you about is taking Social Security early or too early. So there's a couple different reasons why not to that I'll go over. just know that the longer that you can put off taking Social Security, the better. Here's why. At 62, you could get Social Security. Let's just say at 62 years old, I'm going to get $2,000. That's a lot. Let's say I'm going to get $2,000 from Social Security. Every year that I wait to take my pay it, but $2,000 a month, I get $2,000 a month, right? Every year that I wait, that $2,000 goes up by 8%. So times 0.08, I'm going to make an extra $160 a month rather, on my Social Security. Well, that 2160 then in year 2 becomes 2332. There is no annuity in the world that grows by 8% every year that you wait. And that's really our pension. There's no pension, there's no annuity that will allow your income stream to grow by 8% guaranteed by the federal government, much less an insurance company. So the issue then is as you are planning now to retire, you gotta look at yourself and say, hey, how can I live in such a way that I can push past 62, right? And then I get to 65. Well, what happens at 65? What happens at 65 is you start having to take care of your Medicare costs, right? And so that's going to come out of your checking account. So a lot of people will turn on their Social Security because they're like, hey, I really don't want to. Why isn't this advancing? There we go. Oh, well, that picture was so worth the wait. Look at that, it's amazing. Obviously, then what ends up happening is people say, well, I'm going to turn it on at 65 because I don't want to pay that $250 for Medicare Part A, B, C, D, whatever they're paying for. If we can plan ahead, pushing your Social Security benefits, compounding by 8% is very, very powerful. There's something else that you have to be aware of as well. And that is that you have to know when to take it and you have to know how to take it. One of the reasons for that is because if you are married and your spouse is significantly younger, or there's a significant disparity, you have to remember the money that gets left behind is the higher number. So in this particular case, how do I pause this? This is on automatic. Okay, so the husband gets 2,000, she gets 1,200, there's 3,200. While they're both alive, that's plenty of money. They're living their best retirement. But what ends up happening is unfortunately he wasn't raised Adventist, and so he drops dead, right? Because we live forever. So anyways, just kidding. The point is he dies, she gets $2,000 a month, and hers is gone. So the lost $1,200 of income is a 38% reduction of income. And so that's one of the reasons why. That's something I want you to really think about. I want you to think about Social Security, because Social Security, I see it time and again, it is a major factor in the quality of your retirement. Knowing that there's going to be, in this case, a $2,000 check. If he had not done that, sorry, I will fix this to make it not automatic next time. If this gentleman had not taken his retirement at 62, this number would have gotten up to probably $2,900 a month. And his wife, they would have had $2,900 and $1,200 to live off of, but then she would have had $2,900 when he passed away, or whoever. We can switch the genders. This is just a simple way to share with you the disparity. And so this is a big deal. Also, too, the thing about this lost income is typically it's okay in the sense that it takes less to feed one mouth than it does two, right? So that 33% reduction is or 40% reduction sometimes, that's kind of understandable. But why not leave behind for your legacy the biggest amount that you possibly can? So one of the reasons why this is not promoted is because financial advisors oftentimes are making money based upon charging a fee of assets under management. So do they want you to go from 62 to 70, taking out 4, 5, 6% from your portfolio? No, they don't. So they want you to pay the bills with Social Security. That may not be the best thing for you. It's definitely something you want to analyze, especially if you're married and have a disparity, in income levels. So very good. Excellent. So we're almost here towards the end. You guys have been very patient with me. I know this is not the most exciting stuff in the world, although it can be exciting if you make the mistake, and that happens. So one of the other things too is I want to say that not being comprehensive, and the key here is this is going to sound like, I'm trying to promote myself and promote Phil and promote your CPA, and I am. It doesn't have to be the three of us, right? But it needs to be people that you surround yourself with. And here's why. Because essentially, when you are talking to your doctor, what you don't realize is he talks to you for about a minute, right? And then what ends up happening is you've got support people and other types of practitioners and other types of doctors that are coming in and doing lots of different stuff. The reality is that the medical system is, it would be strange if you tried to do it yourself. But when you do it with your money, it is the same type thing. My father is retired now, but he was a surgeon his whole life. I remember one time my mom was sick and she had a really bad fever and she'd gotten dehydrated. So it was time to maybe put in an IV, right, and give her some hydration. Well, my mom's a nurse, my dad's a doctor. My dad said, oh, no problem, I can do it, right? How do you think that went? When a husband tries to put an IV in his wife, and he started to do it, and then he said, you know what, I can't. Why? You can't do a medical procedure in your own family. It's too emotional, right? So my dad was never able to do an operation on me. It's just not done. When you're working on your own money, when you have blind spots, you have emotions, but also too, you only have so much expertise. So Phil and his colleagues in other conferences and attorneys, they have a job, and their job is to figure out how are these assets going to be controlled by you from beyond the grave, right? I mean, that's essentially what it is. I didn't make it sound very fancy, but what they're trying to do is give you control so that your wishes get carried out long after you're gone. And that's their specialty. They have forgotten more about estate planning than I'll ever know. And I know a lot about estate planning because I have to, right? In fact, it's funny because just this afternoon, we were talking to some clients and they inherited a bunch of IRA money, and the will said the IRA was supposed to go to 5 kids, but the actual IRA said it's going to go to 2 kids. Who wins in that case? Oh, but
the 2 kids.
The 2 kids won. The 2 kids won. So the financial planner wasn't me. I just met these people. The financial planner, he didn't even ask. He didn't say, well, is this who you want? He just took the beneficiaries that before, that were already there. He didn't ask about the estate plan. And the estate planner, a lot of times what happens with these estate planning attorneys, they write these beautiful documents, but they're not there to help implement and fund, right? So everybody has to be working together, and you need to make sure that you have a multitude of counselors, but you also need to make sure that we're coordinating with the right questions and following through. There's investing, there's financial planning, meaning, when to take Social Security, the whole benefits package. There's taxes. I haven't even touched on taxes. One of the biggest things about taxes, a tax blunder I'll share with you, and this happened this last year. People don't want to take a loss on an investment, or I'm sorry, they don't want to take a gain on an investment because they don't want to pay taxes. Oh, I don't want to take that because then what ends up happening, and this happened in 2022, they give back those gains because the tax tail wags the money profit dog, so to speak. We put the cart before the horse, if I can mix my metaphors. And so taxes are a big issue. Last year was an amazing time to be able to sell at a loss and then rebuy in a different form the exact same assets. So tax loss harvesting is a big deal. Also, one big blunder that I see, well, there's a lot of blunders actually. Another blunder that I see is people who make a lot of money right before they retire, and then they go to get their Medicare, and it's called IRMA. The government looks at them and say, oh, you're a rich person. You're going to pay top dollar for all your Medicare benefits. Well, no, I'm a normal person. This is just a big business that I sold. Now, the beautiful thing about it is you can actually push back against the government. They've been very good about giving forgivenesses in this case. But taxes are a big deal. So find yourselves some fiduciary relationships and make sure that you hire some folks, talk to a lot of people. Something that Phil said that I thought was very important. It says it costs you nothing to learn. And so you're here today. We got 50 some odd people here today. Learn, and you'll end up being able to sleep better at night. You'll be a much better steward of your time, talent, and treasure because of it. So I think that's pretty much the best of the blunders that I can think of. I'm open to questions. I realize that, my presentation was so complete and awe-inspiring, you're all speechless. I understand. So if there's no questions, I'll just assume it's tacit praise.
I see Deborah with her hand up.
Yes, thank
Hi,
you.
Deborah.
Thank you for the education. I appreciate it. I wanted, when you talk about not selling your stocks or stuff, I wanted to know, is Robinhood viable? Is it a good place to trade?
Yeah. Well, let me say how Robinhood and how everybody, not everybody, but everybody makes their money if you're trading stocks. And they say, oh, we're not going to charge you a commission, or we're not going to charge you much of a commission. What they're doing is, it's complicated, but they're paying you're placing an order to say, I want to buy Apple stock.
Mhm.
Someone's paying to actually sell you the Apple stock. And what they do is, one of these companies called Citadel, and they were investigated. Congress investigated them, and Congress said that's fine. Of course, the problem is they're also lobbyists to the Congress people that were investigating them. But anyways, what they do is they have this fractional price differential of what they bought your order for and what they sold you the stock for. And it is it's a fractional difference. You don't see it, and you're happy. You say, I'll buy it at the market. Well, the market actually changes, and these people are making 1/10 of a cent, but they're doing it based upon $1 billion. And so that's what's happening behind the scenes. It's very technical and weird. I cannot comment and say that I know for a fact that Robinhood is solvent and going to do really, really well, and they're never going to crash. I can't tell you that. All I can say is in a good market, everywhere is safe. And in a bad market, you start to see cracks in the armor. I can't comment on and advise on Bitcoin, but I can tell you that when Bitcoin prices collapse, all of a sudden we find out there's this place called, what was it called? FTX or something. And all these weirdos. Yeah, all these weirdos were just being weird and not being truthful about any type. And someone here said Robinhood got fined 3 times for doing that. Yeah. So they do all these terrible things. And if everybody's making money, nobody cares. But like 2008, no one discovered Bernie Madoff until 2008. And Bernie Madoff was the advisor, he was the compliance department, and he was the Robinhood. So he printed statements. So I would say trust but verify. And I have not heard anything. Well, Google's your best thing. Put it this way. In the financial world, everything is adversarial. I hate to say that, but we do not live we're not in heaven yet. So everybody is trying to make a dollar, and they're not necessarily disclosing everything. And the job of a fiduciary, the job of good people, is to come in there and let you know, hey, everybody's doing what they're doing, but let's just disclose what everybody's doing. Robinhood can make their money. That's okay. Just don't be surprised. And then they also have to reveal what loans they're making and what danger they're in. That wasn't even an answer, other than,
I got you. Thank you.
Yeah.
That was the depth of it. Actually informed me, and I can make a informed decision.
Okay. Yeah.
Thank you.
I have a question here that came privately. Would it be okay if I asked it out loud and then I'll answer it? So the question is if I'm married, can I designate my 401k to my kids, and only my kids, at my passing? So let me answer that question. IRA, yes. 401k, which is work-based, 403b, and those type of work-based accounts, depend on the plan design. So many times, and I think the conference offices are like this, in school systems, 403bs, nonprofits, you have to get the signature of the spouse sometimes. It depends on the plan document. So the answer is yes, you can have your 401k go to your kids only at death, but it also depends on the custodian at that time. Some custodians have rules. Those rules were put in place to protect the wife. So what would happen is the husband would take his money from his 403b and put it into an IRA and give up a pension that she had rights to, right? And she didn't know. And so then he lost a pension benefit possibility or income stream. So that's the history behind that. The answer is yes, but it can be no depending on your custodian. Talk to your plan administrator and they'll let you know in your case.
Thank you, Ray. Any other questions? That was a great question about Robinhood, Deborah. Thank you very much.
Yes, my pleasure. Thank you so much.
Other questions?
We still have 4 minutes, so take
Okay.
advantage.
Good. Oh, I could have talked some more. I can't believe I left that much minute. Okay, well. I'll
So in
wait.
the chat, Ray, do you see that?
Oh, how would someone get introduced to investing in the stock market? So there are different approaches to investing in the stock market. And there's a conservative way of doing it, and there's a little bit more of a risky way. So I'll kind of take it from both extremes, and then perhaps there's a mix in the middle. I don't have the slide ready, but imagine a pyramid. At the top of the pyramid, there are the buying individual stocks that you've never heard of. That's the riskiest thing you can do. It's also where you can make a ton of money, right? So think about it. If you bought a $4 Apple stock in 1983, how would you be doing right now? Well, the janitor who, put $400 away is a millionaire, right? So if you can find Apple stock when it's $4, a small company, then that's one way of doing it. You can go to Robinhood, you can go to anywhere you like to go that sells individual stocks, but that's risky. You could also lose everything. Higher the risk, higher the reward. Another way is in your 403B or your 401k at work, simply buy mutual funds. Mutual funds, or so with mutual funds. Mutual funds are where we all put our money together, and it's either, let's say it's a S&P 500, which is 500 largest U.S. stocks, joined together. We put your money in there, and you get a fraction of a piece that's worth $1 of the S&P 500. Is it as exciting? No, but the S&P 500 probably isn't going to disappear like itty bitty little stocks can. And so in between the very risky top of the pyramid where you can make a ton of money, and the S&P 500 where you can make some money, but you can also lose some money. And then there's more conservative investments. And we say conservative based upon volatility, which is the way it has historically gone up and down. And the lower the volatility, that means the lower the high amount you can make, but also the lower that you can lose. And you're not going to find very many opportunities where you're not giving up some risk for some reward. So that's what my answer would be. I would definitely make sure that you're contributing to your 401k at work. It's easy, it's systematic, and you'll get to understand stocks through the mutual funds. And if you want to, take a little bit of money to a place like Robinhood, where they can let you buy fractional shares of an individual stock for $10. Just remember, if you're investing for retirement, it's a different mentality than you're investing to, buy and sell stocks. You could lose everything, and you have to be okay with that. The question here, how do we set up a distribution of our assets to our kids that avoids taxation for them? Avoid, I don't know how to avoid taxation. Mitigate taxation, you could do a Roth conversion. Roth conversions are where you pay taxes now so that they don't have to pay taxes later. By the way, if they inherit your IRA, they've got to get rid of it in 10 years. That can be a lot. If you're 65 and they're 45, you're not going to die for a little while. Well, if you die when they're 60 and they're still working, they're making lots of money. They're in the highest tax bracket that they've ever been in, and we're in a higher tax structure in the future. So Roth conversions now are better than paying full boat later for them. However, in both cases, we mitigated, we did not avoid, right? And so that's a great question. And if I had a better answer, I would give it to you, but unfortunately, taxes and death, I think, are what we can count on.
Very good, very good. Any other questions that anybody wants to ask now? Certainly, we're going to put up Ray's contact information, and would encourage everybody to reach out to him, privately if they would like to. One of the takeaways here, Ray, that I really appreciate, I have considered this idea of when to take Social Security. I'm not there yet, but I'm narrowing down on it. One philosophy is, hey, if you start taking it earlier, you're getting that cash now that you could live on or invest. And yeah, it's going to be lower than what you're getting 5 years from now, but that's 5 years worth of money that you got. And so that seemed like it made sense to me. However, I really like what you're saying in the sense that if we, if our spouse is going to live longer than us and he or she did not make as much as us during their working years, and so their Social Security benefit is going to be lower. When we pass, they're going to be, left to just live on, the higher one, but the higher one is not going to be as high as it could have been if the person had waited. Did I say all that correctly? Was that confusing?
Absolutely. And so what you have to do is you have to look at the numbers. And so what a lot of people say is, well, if I take it at 62 and I just squirrel away that money and I buy great investments, I'll end up leaving more money to my kids than if I had waited until I was 70 and there was an income stream. So a couple things to look at. There's the age difference between the husband and wife. There's the income difference between the husband and wife. And then you have to look and say, does the delta of 8% compounding from 62 to 70, can you really beat that? I mean, I can't promise you that I can get you an 8% increase in the little squirrel nuts that you're putting away, from your income stream that you promised me you won't spend. In other words, you're turning on Social Security, you promise not to spend it. And I didn't mention this. If you take your Social Security before your full retirement age, which probably is going to be 66 to 67 for everybody on this call, the government says, if you take it before that, you can't make money willy-nilly. You can't make a lot of money. You need to be retired. So what we're going to do is we're going to claw back some of your benefits of your Social Security because you made more than, I think it's $24,000. I'm the worst financial planner because I never remember these numbers, like where they are. I have to Google it because it changes every year. I'm still thinking it's $3,000 for an IRA. I've been doing this too long. The point is timing your Social Security and the penalties for earning too much. There's a bunch of moving parts. And booking a time with a financial planner to kind of look at your particular situation is really worthwhile. And then talking with your spouse. If you are typical, yeah, do it one way or the other. But what if you have health issues in your family? What if you're like, hey, I have special things that don't apply to the general public? It's an individual thing, but do you know the rules? And let's figure out what the possibilities are.
We have two people that raised their hands. I don't know if they have questioned Deborah and Vicky. Yes? Okay, go ahead, Jim.
Okay. I'm in the Florida retirement system, so I have a pension with them. I'm also in our drop program. I'm sure you're familiar with that.
Absolutely.
My exit date, my last day of work will be around the 1st of December 2025. So I'm going to get a nice lump sum from that drop. What would I want to do with that money? Where would I want to put it?
That's a great question. So the drop, I would say you'd want to take a look at your existing assets. And my knee-jerk reaction is, how much cash do you have? How much growth money do you have? And what do you have to kind of be in that in-between stability pillar? So I don't really have a great answer for you individually. I'm happy to look at it and talk with you about that.
Okay.
But I will say the fact that you have Social Security and a pension, correct?
Yes, and the 403B also.
Get out of here. You are set. I don't care what, you don't tell me anything. If you've got a pension and you've got Social Security, you are the dream of every financial planner because we can't screw it up, right? Because you wake up, right, and there's a check in the mail, 2 checks from the government. And of course you earned it because you probably weren't making $1 million a year like some entrepreneur with no Social Security and no pension. Okay, so
Right.
you took a different type of a risk reward, but the best years are yet to come, sir. So good for you. Yeah, but happy to take a look at that for you if you want to just talk real quick after the later.
Thank you.
Okay. Thank you. And the last one is Deborah. Deborah, do you have a question? Oh, probably she already asked. Okay.
Yeah, mine was answered already. I'm sorry. Let me lower my hand. Thank you.
Maria had a
Sounds good.
question.
Okay, so it is 7:05, and I think we went over 5 minutes, but it was great. Do you have any last words, Phil?
Well, I just really appreciated the example that you used, Ray, when you were talking about the beneficiary designation to the 2 kids versus the will. And one of the first things we ask people to do when we're helping them with their estate documents we try to teach people how to make their will unnecessary. And you can do that through a couple of different strategies and options. And one of those is through beneficiary designations. So we always tell folks, first thing you want to do is take out a legal pad of paper, yellow piece of paper, and just write down all of your assets, the house, the car, the RV, the boats, the checking accounts, the CD, the money market, each one individually, and then verify how they are titled or owned. That's critical. If one spouse moved to Florida before the other one did for maybe school reasons or something like that, and that first spouse bought the house or bought the car, and out of convenience sake, because they were the ones there at the dealership or at the realtor, they signed the documents. And so that asset ended up in just one person's name. The other spouse, comes to town a few months later, has a house, and everybody and their brother knows that house belongs to both of them, that car belongs to both of them, but legally it doesn't. And so if one of them passes, all of a sudden there's a problem. Now, I'm not an attorney, not giving legal advice here, but I'm just saying one of the first thing we ask folks to do is to write down each individual asset, because each asset stands on its own. And if the checking account is joint, but the savings account is individual, and that individual dies, well, the bank doesn't know what you intended to do with that. Did you mean for it to go to your spouse, or maybe you didn't? And so they're going to make you probate those funds to determine who they were supposed to go to. So I really appreciated that example. That struck a nerve with me, because it's critical that you know who the owners are and who the beneficiaries are on every single asset. That's the kind of stuff that we discuss with folks. The Plan Giving and Trust Services Department for, I know, Kentucky, Tennessee, Georgia, Cumberland, and for Florida has advanced light years beyond where we were 10 and 15 years ago. It's not just a matter of getting your will done and being done. No, sir. We discuss the whole picture, and you walk away from this process, which, by the way, costs you absolutely nothing, with a full encompassing estate plan. So I encourage you to reach out to us. We would be happy to talk with you. Nowadays, especially after COVID, most of the stuff we do is over the phone and through email. You don't have to come to our office. We don't have to come to your home. It's very easy and convenient. Thank you, Adele, for sharing the screen. You see our next seminars that are coming up. Please go ahead and make a note on your calendar and plan on attending those. We may add another during the year if time allows, but we've got a very, very busy year this year. But we hope we hope to see you again at one of these others. Our contact information, you can email us at plan.giving@Florida Conference. You can call us, our website, Facebook, however you want to reach out to us. We'll be happy to do so. If you want to reach out to Ray, here's his contact information. I love that email address, GC, Georgia Cumberland, grateful.living.com. That's awesome. And then Silka email address is right there, very simple, shubbard@kytn.net. So take a picture of that real quickly with your phone or jot it down. And please, folks, it's free. We're here to serve you. This is our ministry. God has called us into this, each one of us, because each one of us could be doing something else, but we love what we do, and that's helping you. So please allow us to do so. Reach out to us, and we're happy to help.
Can I get the screen again? Thank you. The contacts, kindly.
Which one? This one or the other one?
The previous one. Thank you.
That one?
Yes. Yes. Thank you. Got it.
Jack, thank you for your question. Yes, we will, anybody that emailed us to attend this webinar will receive an email announcing the next webinar and give you an opportunity to RSVP for that.